Taxation of software as a service, or SaaS, is complex for a number of reasons. Software as a service is accessed remotely, and there is no transfer of tangible personal property. While some states consider software as a service to be canned or pre-written software accessed remotely, other states view it as a service. For these reasons and others, it is an understatement to say that the imposition of state sales and use tax on software as a service is complicated. Let's take a look at how a few states treat software as a service. Effective July 1st, 2024, Vermont repealed its sales and use tax exemption for pre-written computer software accessed remotely, otherwise known as software as a service or cloud software. Vermont imposed its 6% state sales and use tax on sales of such programs. The repeal of the exemption primarily applies sales and use tax to software as a service or SaaS cloud applications. To do this, Vermont amended the definition of tangible personal property to include pre-written computer software, regardless of the method in which the software is paid for, delivered, or accessed. As of July 1st, 2024, all sales of pre-written computer software are subject to Vermont sales and use tax, including software purchased on storage media, downloaded to a computer system, or accessed remotely via the internet. In Vermont, software as a service is taxable. The Florida Department of Revenue issued a technical assistance advisement in August 2016 that held that sales of cloud computing services sold by a taxpayer to its clients were not subject to sales and use tax. Why? Because the taxpayer did not deliver any tangible products to its clients. A sale that only involves canned or customized software that is electronically downloaded by a customer is exempt because there is no conveyance of tangible personal property. In this instance, the server was in a state other than Florida, and when the taxpayer asked if it would make a difference if the server were located in the state, the Department of Revenue declined to respond, saying that question was a hypothetical and unrelated to the transaction at issue. In a private letter ruling issued in 2021, the North Carolina Department of Revenue held that subscription fees to access a cloud-based software as a service platform for customer engagement and marketing was not subject to sales and use tax. Why? The taxpayer provided access to its cloud-based application software via the internet. The software was on out-of-state servers hosted and owned by a third party. Moreover, the taxpayer's customers did not receive a tangible copy of the software as part of the subscription fee. Customers could not download, copy, or modify the software. As a result, such subscription fees were not subject to North Carolina sales and use tax. In a 2024 decision by the Texas Comptroller of Public Accounts, the comptroller held that software as a service was subject to sales and use tax as data processing. In Texas, data processing is a taxable service. Such service includes computerized data and information storage or manipulation. Moreover, data processing service providers include sellers of software as a service and application service providers. The evidence demonstrated that the taxpayer purchased software as a service from a third-party vendor, and although the vendor argued that its service was non-taxable, the comptroller held that the taxpayer purchased taxable software as a service. The issues we've discussed today are only in regard to software as a service. They exclude other tangential and related services like training, support, maintenance contracts, etc. These related services only make the topic that much more complicated, and they can affect taxability. Software as a service providers must remain keenly aware of each state's laws, regulations, and rulings, because although some may argue that technology simplifies our lives, others, like software as a service providers, must navigate those waters very carefully.